Good morning, everyone. This is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, June 16th, 2025. So, as always, we're going to go through the economic data that hit last week. On average, I'd have to say it was positive. Then we'll go through how the markets responded. Also had some geopolitical event that we'll talk about just very briefly, and then look at the economic data to be released this week. So last week, the big news was inflation data. We had inflation data on both Wednesday and Thursday. We also had, as we do every week, we had initial jobless claims and Michigan consumer sentiment. But we'll start on Wednesday. So the CPI and CPI core, both of those measurements came out both on a monthly and on a trailing 12-month basis, both very positive. So this definitely moved the market up last week, particularly the fixed income market. So the CPI, the inflation rate month over month, was expected to be a positive 0.2%, came in at a positive 0.1%. And then if we look at the core month over month, expectation was a positive 0.3%, but that also came in at a positive 0.1%. So very favorable. Inflation now, well, on an annual basis, the core actually dropped down. It's now at positive 2.8%, trailing 12-month, but the headline number, 2.4. Last week, we talked about the PCE, personal consumption expenditure, even lower at a 2.1% annual rate. So on Thursday, then we got the producer price index, both the core and the headline number. The headline number came in slightly better than expected, was expected to be a positive 0.2, came in at a positive 0.1. Core was even better, expected to come in a little bit higher at a positive 0.3. That came in at a 0.1. So the inflation data last week, very favorable for the Federal Reserve, their ability and willingness to cut rates later this year. So that's all good news. The only real negative indicator last week was initial jobless claims. So we've mentioned many times on this podcast that we expect the labor markets have softened. We're a little surprised they've held up as well as they have, and it's been pretty impressive. But definitely GDP growth is slowing, so we wouldn't be surprised to see some pressure on initial jobless claims and ultimately on non-farm payroll. So we are starting to see that on initial jobless claims. The expectations for the data that was released on Thursday was 240,000 new claims, came in at 248. Last week, same thing. Consensus was set, and the actual number was considerably higher. So it's not off the charts bad, but certainly the trend is higher initial jobless claims on a weekly basis. Only 3 months ago, we were averaging between 215 and 220,000. Now we're 240,000 plus. Last metric, which came out on Friday, was the Michigan consumer sentiment number. Now that has the chart, we showed it last month, horrible looking chart. We're at the worst levels since inflation peaked back in June of 2022. The expectation for the June number was 53.5, but surprise, it came in at 60.5, so much better than expected. And all we can say on this is that the entire series is starting to feel less useful from a predictive standpoint. We've mentioned the University of Michigan did a change in methodology in how they solicit responses on this particular sentiment index. That was finished last June, which kind of makes a year over year not so comparable. But even setting that aside, like the last couple of months has been pretty volatile. The fact that we thought it would be 53, came in at over 60, that's a pretty big miss. But bottom line is, it is favorable. 60, obviously better than the 53, but well below the levels we were seeing just February of this year. So last thing to mention, we'll go through our normal looking at GDP and everything. But the other big factor last week clearly was Israel attacking Iran. No commentary on it. Simply, that definitely roiled markets last week. So we were on pace for an up equity week. And Friday, things reversed quite a bit. So we'll look at those numbers in just a moment. Before we do, We're taking a look at the Atlanta Federal Reserve, their expectation for second quarter GDP growth. You may recall we've talked about the fact first quarter was artificially depressed given huge flux of imports that we believe were tariff-driven, individuals, companies buying before tariffs were actually invoked. So it was a major headwind to the first quarter GDP, which came in at a revised negative 0.2. For the second quarter, some of that will reverse. So the Federal Reserve, the Atlanta Federal Reserve, believes that we're going to grow 3.8% GDP growth in the second quarter. So again, we just say simply average those two, and we're running at roughly a 1.8% GDP growth in the first half. If this 3.8 is correct, 1.8 would be very reasonable. Below what we had last year, we averaged about 2.8%, but 1.8% growth is pretty decent. So inflation expectations, that has actually come down a little bit. Expectation, inflation will average over the next 10 years 2.28%. There is a Federal Reserve FOMC, Federal Open Market Committee meeting starting tomorrow. They will release the minutes, have a conference on Wednesday. The expectation, 99% plus. No change for this go-round. Pretty confident that will be the case. However, the odds of at least 2 cuts between now and the end of the year rose just slightly last week. It's went from 63 to 64%. The probability of 3+ cuts, that also went up marginally from 23% to 25%. So we'll see what the Fed has to say on Wednesday. That has the ability to move the markets, but as we're discussing this with you now on Monday, the expectation is we'll get likely 2 interest rate cuts, 0.5%, between now and the end of the year. So we mentioned the fact that we had the Israeli bombing of Iran on Friday of last week that took equity down. So full week, S&P 500 down about 0.4%. Growth got hit worse in value, growth down 1.3%. Also for last week, developed markets ex-US, let's just call it flat, down a few basis points. Emerging markets, however, actually up last week, 0.6%. So let's just take a look on a year-to-date basis through Friday. S&P 500 up just barely, up 2.25%. But developed markets ex-US up 15.8%. Emerging markets up 10.7%. Now, fixed income last week, again, really largely based on the issues that occurred on Friday, the Israel-Iran conflict. There was a flight to quality. Treasuries rallied, so the 2-year Treasury down 9 basis points, the 10-year down 11 basis points. The result, the Bloomberg U.S. Aggregate Bond Index up a very strong, call it 0.7% last week, and now on a year-to-date basis, up about 2.7%. So, economic data for this week. It's a very light schedule, probably relatively lacking in impact. Probably the greatest movement will be likely after the Fed decision, which is given on Wednesday. On Tuesday, retail sales ex-auto. The expectation is retail sales, the headline number will shrink actually. So for the month of April, it was barely positive, month over month, 0.1. That's expected to be down 0.7% month over month. And then retail sales ex-auto for May, that is expected to be exactly where it was in April, which is a positive 0.1. Wednesday, we have housing starts, building permits. That hardly moves the markets. I won't even bother talking about them. Initial jobless claims, though, expectations are rising for weekly claims. Recall last week we mentioned coming into the week, expectation was 240,000. The actual was 248. The expectation for this week has risen, and so the consensus is 245,000. And lastly, the Fed rate decision, again, 99% probability built into the futures market that there will be no changes to interest rate policy from the Federal Reserve. So that's it for the economic recap this week. We thank you very much for your attendance, and we'll look forward to seeing you next week. Thank you.